Home prices are more to do with sentiment than fundamental economics. And this week we saw new data which is likely to change sentiment. So, are home prices on their way down? Welcome to the Property Imperative Weekly, to the 25th of November 2017. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. We start this week's digest of finance and property news, noting that auction clearance rates continue to drift lower, especially in Sydney, and home prices are easing back as the supply-demand equation changes. CommSec said that the average floor size of an Australian home, that's houses and apartments, has fallen to a 20-year low, with the typical new home now 189.8 square metres, down 2.7% over the past year, and the smallest since 1997. Though Australians continue to build some of the biggest houses in the world, an increasing proportion of Australians, especially in Sydney, Melbourne and Brisbane, also want smaller homes like apartments, semi-detached homes and townhouses. Generation Y, millennials, couples and small families want to live closer to work, cafes, restaurants, shopping and airports, and are giving up living space for better proximity to the desirable amenities. CBA also makes the point that since 2014 the number of people per dwelling has been falling. Lower interest rates and the increased supply of cheaper apartments, compared with houses at least, have prompted older couples to downsize, more Generation Y have been looking to move out of the home, and take ownership of accommodation more appropriate to their needs. Also, on the supply-demand property equation was an important study from the ANU. Now, the government view is high home prices is ultimately driven by lack of supply relative to demand, including from migration. So the solution is to build more, flick past to the States. It has nothing to do with excessive debt, nor does the fact the average number of people per home is falling signify anything, and tax policy is not the problem. But the working paper Regional Housing Supply and Demand in Australia from the ANU Centre for Social Research and Methods blows a mighty hole in that mantra. They suggest that demand factors, including the availability of loans, tax concessions and other factors, have a significant impact, while demand and supply equilibrium varies significantly across different regions, with some hotspots and some places where vacant property exists, and yet prices remain high because of these various demand factors. Significantly, much of the surplus is in areas where high-rise development has been strong. We think this may signal further downward pressure on prices in areas like central Sydney, Melbourne and Brisbane, as well as Townsville and Cairns. On the other hand, there is a shortage of property in Adelaide and some other out and urban suburban areas. Wayne Byers, APRA chairman, spoke at the Australian Securitisation Forum. Household debt is high, he said, and continues to rise. He identified three mortgage-related risks. First, the trend in non-performing housing loans is upward, despite a relatively benign environment for lenders. In fact, the overall rate of non-performing housing loans is drifting up towards post-crisis highs without any sign of a crisis, and when rates are ultra-low. Second, while the upward trend in low net income surplus lending appears to have moderated over the past few quarters, a reasonable proportion of new borrowers have limited surplus funds each month to cover things like anticipated expenses or to put aside as savings. And third, there is only a slight moderation of the proportion of borrowers being granted loans that represent more than 6 times their income. As a rule of thumb, an LTI of 6 times will require a borrower to commit 50% of their net income to repayments if interest rates returned to their long-term averages of a little more than 7%. High loan-to-income lending in Australia is well north of what has been permitted in other jurisdictions grappling with high house prices and low interest rates, such as the UK and Ireland. So APRA has finally acknowledged that there are risks in the system, and it is finally looking at loan to income. Better late than never. LVR is not enough. He also called on the finance industry to, quote, devote more effort to the collection of realistic living expense estimates from borrowers and give greater thought to the appropriate use and construct of benchmarks. So, how big is the problem? Well, the long data series from the Bank for International Settlements comparing household debt to GDP shows that Australia sits at the top of the international list just after Switzerland at 122%. Australian households are wallowing in debt, which is no wonder mortgage rates are so high. Even relative to Canada, where home prices have now started to fall, Hong Kong, where prices are in absolute terms higher, and New Zealand, where the Reserve Bank there has been much more proactive in tackling the ballooning debt. Ireland is still trying to deal with the collapse which followed the GFC in 2007, and they have registered a significant plunge in debt. Another BIS series, Trends in Home Prices, which was updated this week, shows Australia is near the top in terms of growth relative to other Western countries, including the UK, USA, Canada, and New Zealand. There is an important lesson in this data. If prices do crash, it can take significant time to recover. Home prices in Ireland, for example, which peaked in 2007, 10 years later are still well below that peak, a salutary warning. USA prices have now just passed their pre-GFC peak, and the UK achieved this in 2014. So the fallout from home price falls casts a long shadow. The fall in prices took on average 5 years from their peak to the subsequent trough. So a warning that if Australian prices slide, they could do so for many years. The IMF issued a warning this week based on their latest Australian visit. They warn that growth will be modest. More effort is required to contain housing risks, including macroprudential, and a structural reform agenda is required to lift productivity and growth. They say near-term risks to growth have become more balanced, but large external shocks, including their interaction with the domestic housing market, are an important downside risk. The housing market, they say, is expected to cool, but imbalances, lower housing affordability and household debt vulnerabilities, declines in household debt-to-income ratios would need to be driven by strong nominal income growth and amortization of loans. The IMF, however, is stuck on the supply-side policy mantra as the most effective approach to achieving household affordability in the longer term. The RBA had a good trot this week, with Head of Financial Stability Jonathan Kearns saying the bank has responsibility to promote the stability of the financial system as a whole, and so carefully monitors property markets, because poor commercial property lending and the large stock of residential property debt means risks to financial stability and household resilience. The high valuation of commercial property increases the potential for a sharp correction, and so the risks from commercial property lending. The high level of household mortgage borrowing also brings risks, both to lenders and households. He also discussed the impact of purchases and financing by foreign investors and banks. Nationally, purchases by foreign buyers are equivalent to around 10 to 15% of new construction, or about 5% of total housing sales, he said. These purchases by foreign buyers do not, on the whole, reduce the supply of dwellings available to local residents, and in fact may actually contribute an expansion of housing stock, though such purchases by foreign buyers, particularly for investment purposes, are a more recent phenomenon, and so their impact on the housing cycle is less clear. Marion Kohler, head of Domestic Markets Department at RBA, explored more from their mortgage securitisation dataset. There were two insights. First, the loan-to-value distribution is highest at 80%, which is skewed because of the securitisation rules. But her claim on average securitised loans appear to be no riskier than the broader population of mortgages was unproven. Secondly, there was some interesting commentary on mortgage rates, with interest-only loans now significantly higher. There is now a greater proportion of principal and interest loans with an interest rate below 4% due to the lower rates applied to owner-occupied loans. And there has reportedly been increased competition for these types of loans. She did not discuss the critical loan-to-income ratios, which should be available in the data. Finally, RBA Governor Philip Lowe spoke at the Australian Business Economists Annual Dinner. Essentially, the conundrum of low inflation and wage growth, despite better employment, means the cash rate will stay lower for longer, though the next move is still likely up. High household debt is less about risks to the banking system and more about medium-term financial stability, especially as rates rise. Household spending will remain muted. GDP is forecast to be higher because the fall in mining investment has ended, even if other business investment is still low. He also highlighted the bank keeps overestimating future consumption growth. Finally, he said, it is important to be clear that the RBA does not have a target for housing prices, but a return to more sustainable growth in housing prices does reduce medium-term risks. A report by Bloomberg says that the party is finally winding down for Australia's housing market. How severe the hangover is will determine the economy's fate for years to come. After 5 years of surging prices, the market value of the nation's homes have ballooned to $7.3 trillion, or more than 4 times gross domestic product. Not even the USA and UK markets achieved such heights at their peaks a decade before prices spiraled lower and dragged their economies with them. The report cited UBS economist declaration that Australia's world record housing boom is officially over, and the cooling may be happening a bit more quickly than even we expected. The risk is that it leaves the Australian economy extremely exposed, and a minor shock could become far more significant, said Daniel Blake, an economist at Morgan Stanley in Sydney. While the RBA is satisfied that lenders have adequate buffers to cope with any downturn, banks may find it harder to value their collateral in a falling market as investors look to consolidate their portfolio of multiple homes. But now, reflect on this. More than half of all dividends in Australia come from the banks. Data from the latest Janus Henderson Global Dividend Index reveals that Australia's banks pay out $6 from $11 of the country's dividends each year. But dividends are growing slowly, given already high payout ratios. Leading is Commonwealth Bank, which raised its share payout 3.7% on the back of steady profit growth. But National Australia Bank, Westpac and ANZ all held their dividends flat. CBA and Westpac were identified in the report as the world's 4th and 6th biggest dividend payers, respectively. And Chinese and Taiwanese technology and manufacturing companies took the top 3 places. Much of the dividends in Australia comes from mortgage lending. So standing back, home prices have been rising thanks to high local and foreign demand, and from investors who believe in yet higher prices ahead. But now the evidence is mounting that sentiment is changing. Demand is easing, and as lending standards get tightened at the same time. And there's also low wage growth and the rising cost of living to take account of. Our household surveys picked up this trend a few weeks back, and now there is also more awareness of the risks from higher rates ahead. So we think prices are set to slide further, with Sydney leading the way. Brisbane will follow, but there may be a little more momentum left in Melbourne. All the economic data points in the same direction, and our modelling suggests a fall of 20% or more is possible over the medium term. If we are lucky, the easing will be gentle, but it could last for perhaps 5 years. But there is also a risk of a bigger fall sooner. And this would create a negative feedback loop, which would reduce growth and hit the banks hard. No wonder then that many with vested interest in property still want to talk the market up. But the fundamentals don't lie. It's not now a question of if, but when, and how far home prices will fall. And that's the Property Imperative Weekly to the 25th of November 2017. If you found this useful, do leave a comment below, subscribe to receive future updates, and check back again next week. Thanks for taking the time to watch, and see you next time.